Stocks are in danger as a bearish pattern forms. Have yields peaked? We'll look at an extreme curve inversion. Gold could also correct as dollar gains strength, and Precog oil traders make money from attack on Russian warship. This and more market moving news in today's edition for MasterChartsTrading.com for August 4th, 2023. This is Alexander. Please don't forget to hit the like button, subscribe to this channel, share this video, and activate the notifications so that you can get notifications of my new videos. We're looking at S&P 500, and this is a daily chart right now. So each candlestick is a day's worth of activity. You can change this by going into this interface right here. On this chart, you also notice this green, blue, red, and yellow lines. These are my proprietary MasterChartsTrading.com price action indicators, for which you can sign up by going to the link in the description. Now, on daily chart, it's not as terribly obvious. However, let's just look at this pattern at the top here. So last week I pointed out this little candle on July 27th, last Thursday, and I said, could this be a bearish engulfing? Indeed it was a bearish engulfing. We're now moving lower. The important part of this week, of course, was the day between 1st and 2nd of August. Notice this gap down. So stocks gapped down on August 2nd. Yesterday they tried to bounce. They tried to bounce more today, but and I was actually quite optimistic midday, but then completely sold off by the end of the week. Notice that end of the day rather. Notice that the price closed near the lows for the day. If we look at the weekly chart, the picture is even more dire. Well, notice this pattern right here. This is a week of July 24th, and this is the week of July 31st. So Monday, July 31st. It ended this today, Friday, August 4th. So this is a classic bearish engulfing, where today's or this week's candlestick is completely engulfing previous week's candlestick, almost completely engulfing. There's a little tail out the top. The important thing is it is this green body is being engulfed by this red body. Oh, excuse me. By this red body. So this is a bearish engulfing pattern. Now, additionally, notice that this week's close is decisively below previous week. This hasn't happened since March. Notice that we've been pretty much moving higher and higher and higher. The only part right here where I'm hovering, week of May 8th, there is a close below previous real body, but it was not a very decisive close, and notice we continued higher, but this is definitely a decisive close below previous week's low. So by many standards, this is not a good sign. This is a classic bearish engulfing at the top of the range. So looking back at the daily chart, we can see on this chart, again, we have my proprietary price action indicators. The green line sort of marks this, what I call first support. So first support is just, weak, really weak support. Very good support is second support at the blue line, which is currently about 7% away. The green line, which is about 1.5% away only, is kind of like a weak support. So it could sort of, bulls could step in and start buying here, but it's not as strong as down below here. So if by sometime in the future we get to this blue line, I would be very interested myself. Why? Because previously, notice this, for example, breakout right here in April of this year. This is exactly where we bought, and notice we have a very nice run. So this is a, you know, kind of like a trend trading. We have an uptrend in security, and we need to wait for it to pull back before starting to buy again, to start to buy again. And right, you know, when it's at the top here, or even where it's at this green line, it's a little bit, you know, it's not a great buy, because you need to put your stop somewhere, right? Let's say you go ahead and buy it at this green line, and you say, okay, if the security closes below, you know, somewhere, then where would I will exit, because I was wrong. So if we buy around the green line, we need to put our stop significantly lower. We need to put our stop way down here at the yellow line, because at the yellow line is where we're saying, okay, this is now no longer an uptrend, but now a bear market, a downtrend. It's still, you know, pretty far away, like 18% away from today's prices. If we buy around the blue line, our stop is only 12% away. I mean, if the security continues lower towards the red line, then of course you could buy it here. That's only 5% away. But then you're sort of in danger, because we're beginning to toy with a downtrend. And if we get to the yellow line, that means we're switching into a downtrend. Our belief is that we trade with the trend, and so we want to look for a security which is an uptrend and it has pulled back significantly to justify a relatively low risk entry. So that lower risk is about 7% away, or around for S&P 500 at the level of 4,188, around 4150 or so. So if we pull back to around 4150, it would be a very good buying opportunity and a relatively low risk entry. So like I said, this week's definite bearish engulfing, and also this week has closed conclusively below the previous high, previous close of the week, tells me that there is now a significantly good chance for this correction to continue, and we might see a relatively deep pullback, possibly at the very least towards this green line, which is only 1% away, but I think even more likely towards the blue line, which is around 7% away from today's prices. At the same time, treasuries, this is TLT, Treasury Bond Fund, 20 plus year Treasury Bond Fund, very long dated Treasury bonds. They have been, well, the 20-year Treasury bonds have never really broken out. Let me just show you, for example, short-term bonds, SHY. They have indeed broken out. Notice that there is a close above the blue line. I actually own some SHY. I bought in May here. And notice, just looking at the chart, that the short-term bonds, they kind of broke out, and they sort of been trading sideways versus Treasury, long-dated treasuries, TLT. Notice that they never broke out, and now they're actually near the lows. These are possibly multi-year lows, actually. We just had no, it's not. Wait a minute. These are multi-year lows right there in October. If we look, the opposite of bonds is rates, interest rates. So Treasury bond yield. And this is a TYX, 30-year Treasury bond yield. So let's look at it from a weekly perspective, so we just see, you know, longer term kind of perspective and how far we have come. So back here in October of 2022, the 30-year Treasury bond yield hit a 10 plus year high. It means that the bonds have hit 10 plus year lows. Okay, that makes sense. We're now actually approaching those levels. We're very close to those 10 plus year highs for the bond yield. Okay, So bond yield and bond prices move in the opposite direction. If bond price goes up, then yield goes down. If bond price goes down, yield goes up. So in this case, yes, indeed, TLT Treasury Bond Fund is dropping in price, and we have TYX Treasury Bond Yield is going up and going up. All right. Now, couple all of this together with the fact that stocks and bonds normally look, move in opposite directions. Okay, so when investors are not very optimistic about stock prices, they usually switch towards bonds. Okay. In this case, today, this is not exactly what's happening, and Treasury bond prices are actually also going down. However, I think there is a good chance now that we have reached the bottom. And let me show you my thinking. So first of all, let's look at this. This is called an dynamic yield curve. You can find it on StockCharts.com. Just go to chart tools right here. It's a free tool. And notice here where I'm hovering, it says dynamic yield curve. Okay. So this just shows you that, notice that this is a 3 months yields on the left here, and there's 30-year yields on the right here. So notice that the 3 months yields are very high. They're like 5% right now. So you can buy a 3 months Treasury note from United States Treasury and get almost 5% for it after 90 days. While if you buy a 30-year yield bond, 30-year bond, you will only get like 4.5% after, per year, basically, right? So that doesn't make sense, right? This is called yield curve inversion. It says right there, it says inverted. So previous two examples on this chart where we have yield curve inversions, one was back in 2000. So this is also inverted yield curve, not as extreme, but sort of inverted still. And the second example was right there back in 2007, right before. So both of these events happened right before a significant pullback for S&P 500. Notice this S&P 500 here. And notice the current yield inversion is by far the most extreme of these two examples. Okay. Yet, so far, we're not really selling that much. There is not that much selling yet. And my thinking right now is that it would be quite weird for the Treasury bond yield, TYX, to continue higher. I think maybe we have reached the top, and there's a good chance we're going to roll over. Meaning that the Treasury bond yield will continue to come down. I think this also will translate to shorter term bonds as well, and the yield will also come down. So in other words, prices of bonds will continue higher. Now, if we do break below this low for TLT Treasury bonds, below October lows, then I would be wrong, and maybe we'll have like this giant cup and handle, which are extremely bad. That means that we are going to see like a breakout above previous yields, and maybe we'll continue to 5% or even higher for the 30-year yields, and that would mean 7 to 8% for short-term yields. So it's also a possibility, but maybe there is a good chance of that not happening, and coupled with the fact that I think S&P 500 is about to pull back, investors normally in normal times switch their holdings from stocks into bonds. So perhaps bonds will move higher in the next few weeks, and we'll see lower interest rates in the near term. What do you guys think? Make a comment. I would like to know your opinion. All right, let's move on to the dollar DXY. This is DXY on this interface, tradingview.com. Notice that right now I think that dollar is in a downtrend, but it actually hit 52-week lows back here in July and has bounced. Okay, so we're bouncing. We're currently around this yellow line, and I'm not sure we're done. I think the bounce for the dollar has not yet stopped. So I think dollar might strengthen in the next few weeks, maybe into September, and by extension we will see this event pressuring gold. This is XAU divided by USD. So the lower part of this equation, USD, it would get bigger in the next few weeks to month, and it will pull this currency pair lower. Currently, gold is in an uptrend, but a pullback, once again, could continue. Now, there is very good support around 1897. This is the blue line, 1900 or so. Notice this exactly where we bottomed, right there on the 29th of June of this year. We bounced, but I think right now dollar is again strengthening, so we could, I'm fairly certain we're going to continue to pull back towards the blue line, towards around 1900, and we will see what happens to the dollar. So if by then we will get to the red line for the dollar, then I will be looking for something like what we had before. So we had a high above the red line, and then a close below it, for example, where I'm hovering right now on the 13th of March, and that would be a signal to sell the dollar. By extension, it would be a signal to buy gold. This is exactly what we did back here in March. So we're waiting for gold to become oversold, and it would become oversold around 1900, and at that time I think we will be looking for an opportunity to buy it again, provided the dollar doesn't continue to strengthen. And it could continue to strengthen, and who knows, maybe it will re-enter its own bull market, which is currently above 109. So we will see if that happens, but it hasn't yet happened. And for now, we're looking at gold as a potential buying opportunity, which is coming up, especially around 1900 per ounce. So let's be on the lookout for that. Okay, so I wanted to mention this. Precog oil traders make money from attack on Russian warship. Of course, Precogs from Minority Report. I'm a big fan of science fiction. It was a very good movie. Philip K. Dick is not a great writer. It's very confusing. I read many of his stuff. He sometimes goes really, just switches gears and like you have no idea what happened. But the movie was pretty cool, and they had precogs. These are precogs, precognition. They were able to identify what was happening in the future. Now, if you listen to my previous videos, as early as actually May, beginning of May of this year, when I saw this big candlestick here on the 4th of May, I was already questioning a downtrend for oil. Now, oil was, and technically still is, in a downtrend. Notice this downward facing arrows. This was all short alerts. In fact, they were all successful, because oil made a new low here in March, attempted to pierce that low in May, but failed. And this is a clear hammer candlestick, because it looks like a hammer right there, 4th of May. And then I said there's a good chance we will rally towards this red support resistance line. Several attempts were back in June to pierce this low levels around 67, 68. They all failed, and oil rallied. Finally, where I'm hovering right there, on the 24th of July, which is last week, we burst above this red support resistance line, and now we're continued higher. So we're currently approaching blue support resistance line. Now, blue line means a new uptrend for oil. All right, so there is now a very good chance that we will close above that level, and we will, in this case, start thinking that oil is no longer in a downtrend, but it actually is in an uptrend. Even we want to start thinking about buying it on any pullback, or even just on a breakout above this blue support resistance line, which is currently at 84 or so. It will come down a little bit in late August, but the way things are going, and okay, so I said that people are using my precognition skills. Okay, this is not true, obviously. I don't have any precognition skills. I have some mathematics skills, because these indicators are built on math. All right, so literally yesterday there is a strike. Ukrainian drone disables Russian warship near Novorossiysk, what do you call it, port of Novorossiysk, and this is a huge oil hub for Russia. 50% or so of Russian oil that doesn't go by pipes and goes by the sea comes out through this port. So the Russian warship was hit around there, and there's the footage, and then it as a result of this, the shipments of oil into Novorossiysk were stopped temporarily, and the tankers, they stopped being filled in that port. So this is a big deal, obviously, because, you know, if you can't export oil, there is going to be a perceived shortage of oil on the world markets. Now, Russian oil doesn't, it's sort of toxic in a sense because of the war in Ukraine, but some countries still buy it, and it is part of the market for oil. So this, rise in oil prices was sort of expected. Unfortunately, I thought it was going to be because of increased demand because of the economic better economy, more people driving, etc. But in this case, they're clearly because of supply disruptions. So even though that is true, energy companies such as this is XLE, Energy Select Sector ETF, exchange traded fund, and has companies like ExxonMobil, Chevron, and a bunch of other oil related companies. We did indeed trade them. I sent an alert out here in June, on June 7th, and another one right there on June 30th. So if we look at oil, oil was nowhere near the breakout above this blue support resistance line. You can see that we were just expecting, I was anticipating something of this nature. So if you bought oil, energy, XLE, then you already have nice profit here, about 8%. If you held on to this ETF, then good for you. And I would probably continue holding, because the way things are going, there could be more oil disruptions. Basically, right now, if Ukraine says, well, we'll attack your ships, and Russian ships, and the tanker companies would say, well, we're not going to insure the tankers anymore, so they can't really ship oil out through the Black Sea and then out to Bosphorus through Turkey. So overall, this will create further supply disruptions, most likely, unless, of course, all of a sudden a miracle happens and the war ends, which would be one of the best outcomes. All right, if you have any questions, please let me know. Otherwise, head over to MasterChartsTrading.com, click on sign up. I have 3 products, trading indicators, or I have 2 products and 1 combination, trading indicators, newsletters, and both at the same time. The best deal, of course, is to get both trading indicators and newsletters. So newsletters, I send out daily alerts about various securities we trade. For example, last week we traded many of the securities. I send out alerts about ETFs, large cap companies, as well as some of the small cap and up and coming kind of companies like CrowdStrike, Asana, Cloudflare, the RealReal, etc. So if you're interested in that type of trading, sign up. Of course, the indicators are also available. So trading indicators are these lines on the chart. You can use them to trade pretty much any security on most time frames. So for example, oil can be traded, if it's a continuous security, you could trade it on even 1 minute chart. If it's for example, you could have bought oil on 1 minute chart right there, and you made very nice money here. Other than that, thank you for watching until the end. If you have any questions, let me know. Make a comment, share this video, like this video, and have another great trading week. Bye-bye.